We absolutely need to see follow through from the bulls. If we get a close above this candle, anywhere above this candle, I would call that a confirmation to the bullish side. Why would I do that? Why? Well, because the bears had that perfect setup and they failed to produce follow through to the downside. If we get bullish follow through on Monday, this will likely be the beginning of a second bounce. Right, this is the first bounce, and if this low holds, this is likely the beginning of a second bounce. Huge volume. Look at this, even larger than the volume on August the 18th. Bigger volume, green hammer candle, higher low. We cannot ignore any of that. The second step the bulls need is a close above the 9-day moving average, this descending orange line. Just a close above it by Monday would be the second arrow in their quiver. The third and final, I would say, nail in the bearish coffin is a close above the 50-day moving average. Any close now above 444 opens the door for even higher moves all the way to this neckline at 451, this area here. Welcome back, you legends. That was a rewind from the weekend update video. I apologize, guys. I was not able to get a video out Monday. As most of you know by now, my wife had to go through her 5th emergency surgery. She will need another one. Unfortunately, we were informed that there was a recurrence and she will actually need an additional procedure, at least one additional procedure, might be even 2 additional procedures. We're now exploring experimental, cutting-edge treatments. So I do thank you, everybody, for your support, for your prayers. It's worth more than you guys realize. Good news is she got out of the surgery Monday, thankfully. So she's now recovering, and we're now getting ready to set things up for the next surgery. I do apologize for the late upload on this video. I just could not get it out post-market, immediately post-market. But regular video uploads are back starting today, and I was able to get a note out in the trading community talking about the significant technical developments that we were looking for that I discussed in the weekend update video, and they all happened. So let's take a look at them, guys. On the 1-hour chart, I posted this just after the market opened Tuesday morning. On the 1-hour chart, we rejected off the trend line resistance 4 times. Here it is, 1, 2, 3, 4. Up until we broke above it. Yesterday I was referring to Monday, and stayed above it. So we had a break and we consolidated above resistance. That was a very clear bull flag. In addition, we're seeing moving averages bunching up and getting closer, getting ready for a bullish cross. Also a bullish sign. Overall, we're seeing what we typically expect to see at the end of a downtrend, at the beginning of a new uptrend. Price will remain choppy with up and down days until we clear the 50-day moving average. Once that is done, that's when we can expect the market to start moving up with much higher velocity. That's pretty much exactly what happened. As soon as we cleared that 50-day moving average, we had that insane push to the upside. Now we do have a very clear picture that this was indeed a double bottom with a higher low, with a hidden bullish divergence. The hidden bullish divergence that I discussed in the weekend update, it has now been confirmed with a breakup of the 50-day moving average. So we were looking for a double bottom with a lower low and a bullish divergence, and for a rally to start. It is possible that the double bottom has actually developed Friday, and Friday was the double bottom, and it ended up producing a double bottom with a higher low instead of a lower low. And it produced what is called a hidden bullish divergence. So what is a hidden bullish divergence? In terms of bullish divergences, we have 2 versions. The first version is we make a low followed by a lower low, and on momentum, we make a low followed by a higher low. Now, that is a classical bullish divergence, and that's what I was looking for because that's the most common setup for divergences. There's a second way divergence can develop, and it's called a hidden divergence. A hidden divergence, legends, is when the market makes a low followed by a higher low while the momentum makes a low followed by a lower low. This is called a hidden divergence. When you get the divergence with the lower low in the momentum indicators and not in the price action. This is less common. This is way more rare, I would say, but it did happen recently. When? Well, it happened right here on the March bottom. March 13th. What happened on March 13th? Well, we had a hidden bullish divergence. Where's the divergence? Well, price made a higher low versus the low in December, while momentum indicators like the RSI, look at that, they made a lower low, and the PPO, look at this, very close, almost an identical low, very slightly lower, okay? So we had that bullish divergence on the RSI, almost there on the PPO. I would say it was there on the PPO. And recently, what do we have? We have higher lows versus these lows back in June. And again on the RSI, look at that, lower low, PPO, significantly lower low. So if price ends up again closing above the 9-day, then recovering the 50-day, this will confirm this hidden bullish divergence. Now, they're called hidden bullish divergences because they're very sneaky. They're rare. They don't always happen. They get missed quite often by technical analysts. A close above the 50 confirms that bullish divergence and the double bottom, and it actually produces a full measured move. Let's take a look. Boom, here it is. To 455 actually to close this gap. So initially I had a target of 451 to these prior highs, these prior lows. This is clearly a pivot zone. Acted as resistance once before. Once it broke through it, it acted as support once, twice. Once we broke down, and acted as resistance again. And the full measured move actually puts us above 451 all the way to fill this gap, very close to filling this gap at 456. Now, yesterday's move was a huge move. So I'm expecting one of two things. Either we gap up to start the day and then pull back, or we simply open lower and then rally. So one of these two, because this is a huge candle. Usually that's what happens with these massive candles, is we either gap up and then sell off, get some profit taking back to the 50-day moving average. So around 445, 444, something like that. And then see follow through to the upside the next trading day. The alternative is we simply open lower and then continue to rally. Usually, guys, that's the most likely scenario to play out. Sometimes, guys, we just continue to squeeze up and up and up. That's also possible. In either case, I did initiate a long position yesterday in a specific setup that I shared in the trading community. I also talked about Tesla, and Tesla had this really gorgeous setup. Here it is, update on Tesla. It broke above the flag that I discussed in the weekend video, back tested and is rallying again. This was 20 minutes after the market open. I have a short-term target of 255 on Tesla to backtest the 50-day moving average in that highly traded area. Here it is, Legends, 257 to backtest the 50-day moving average. So we realized that target plus 2 additional bucks. So that was a huge move to the upside. And it all happened in one single day. It actually is the full measured move of this bull flag. In fact, take a look at this, Legends. We take the distance from the bottom to the top. We take a look at that again from the bottom to the top. Look at that. So we're probably just a couple of bucks away from realizing the full measured move of this flag. After that full measured move is realized, we can expect some potential, another potential flag and then another breakout. That's possible. Okay, Legends, this video is going to be very brief, so please just pay very close attention. Every single chart, every single thing that I'm going to say is a distillation of all the technical things that we're watching. So that was it, guys. Double bottom, higher, low, bullish, hidden divergence. Again, check that out in the video, the last weekend video if you missed that. We had a break above the 50-day, so we are now expecting high velocity to the upside with potential pullbacks that will be bought. PPO has produced a bullish cross. The RSI is now above 50. Anytime we're above 50, the market is in an uptrend. Importantly, guys, I also discussed this huge bullish divergence on the smart money in the weekend update video. It has now been confirmed with a break above the 50-day moving average on the S&P. The S&P is down below. Up top is smart money. Smart money is already near those highs. So this tells me that the S&P 500 will very likely go back all the way to these highs to 460 and potentially even higher to 461 in the coming weeks until the second sell-off in October that we expect to happen starting by the 3rd or 4th week of September. So we expect a recovery for at least 2 weeks, including this week. So On the weekly chart, we expect a weekly green candle this week, another one next week, then potentially another sell-off towards the end of September into mid-October. In congruence with seasonality, notice guys, we usually bottom in August, see a rally into the third week of September, then a sell-off, another rally attempt into early October, then a significant sell-off and a bottom by mid-October. That's kind of what we're expecting now, and it goes very well with the technical picture that we're seeing right now on the charts. Very important, guys, the VIX. Remember what I said about the VIX in the weekend update video. If we get any close below 15.5, that's it. That's confirmation to the upside on the S&P. We got that close on Monday that confirmed the rally to the upside. We had continuation. Now I expect the VIX to go all the way down at least to 13.9 to fill this prior gap, which means that we should see additional upside in the S&P 500. CPC buy and sell signal, not yet a buy signal, but we're getting close, right? We went to 1.1, we came back down. Now we're just waiting for the cross down on the PPO. That always coincides with significant market bottoms. Each and every single one of these has coincided with a major market bottom. NYSE summation index, we got the first cross above the red line, above the zero line into green yesterday. We're now probably, guys, just days away from the summation index producing a bullish cross. Same thing on the NASDAQ summation index. Down below is the oscillator. We're now back in the green above zero, and we're getting very close to a bullish cross on the summation index. 50-day S&P 500 breadth, massive breakout yesterday. We're getting very close to a bullish cross on the PPO as well. 200-day breadth, another huge breakout yesterday, guys, and the PPO is getting very close to a bullish cross. Every single time we went from red to green on the PPO, that marked a buy signal every single time here, guys. Take a look at this. Buy signal, buy signal, buy signal. We always get additional upside when we get that buy signal. We're likely now just days away from that buy signal. A key chart, guys, is the BPSPX. Remember from my last several videos, I covered this exact chart. Whenever we dip below 38.4 and recover, that always marks the stock market bottom. Let me show you every single time this has happened. Here it is. This week was the first time since that top in July that we recovered the 38.4 level. It indicates that the market has bottomed. Again, another example is this. It actually marked the stock market bottom. Another example is this. Marked the bottom perfectly. Another one right here. Marked the bottom perfectly. There you have it, folks. Marked the bottom perfectly. Again, above 38.4. Marked the bottom perfectly. Another one right here. It actually marked this May bottom. Again, guys, look at this. Marked the bottom every single time this has happened. It actually even marked smaller bottoms, larger bottoms, again in December of 2021 and again in October of 2021. It marked every single bottom and the beginning of every single rally, whether that rally lasted a week, 2 weeks, medium term, short term, doesn't matter. This signal marked every single bottom. So we now have a double bottom with a higher low. We broke the neckline. That's the first major bullish sign. PPO has produced a bullish cross. We also have the RSI above 50. We have the put to call ratio putting in a double top and beginning to decline. Both the PC and the CPC both showing double top and beginning to decline. The NYSE summation index is flattening. The oscillator has already crossed above the zero line and is into the green territory. Same thing with the NASDAQ summation index. Flattening, getting close to a crossover. Oscillator is already in the green. 50-day breadth, major breakout. 200-day breadth, major breakout. So we're getting all the signs of a new uptrend. If you guys want to have access to all of my trades, my trade setups, my daily analysis, all of my investments in real time, check out our Patreon page, patreon.com/moneytimemachine. You will find the link in the description below to join the community. It's where I share all of that good stuff, including that Tesla setup that I talked about at the market open yesterday with that 255 target, which we hit perfectly yesterday. Fear and greed, guys, we're back into neutral territory. It appears that we are now bottoming in the fear and greed section of the technical picture. Market momentum is now rising. Stock price strength is now flattening, beginning to rise soon. Breadth has now bottomed and it's now picking back up. This has always been one of the best signs for a reversal to the upside, a new uptrend. That is S&P 500 breadth bottoming and beginning to pick up pace. Market volatility, we're back below the 50-day moving average. Again, guys, as I discussed in the last video, whenever we're above the 50-day on the VIX, the market is in a downtrend. Whenever we're below the 50-day on the VIX, the volatility index, the market is in an uptrend. Okay, key events, guys, this week. Yesterday, guys, we had the JOLTS job openings, and they came in significantly below expectation. That is a sign that the jobs market is cooling down. That's what the Fed actually needs to begin cutting rates. So that was viewed as being bullish. Consumer confidence also declining. Another sign that should help the Fed finalize this rate hiking cycle, ending the cycle and beginning to cut rates. So it's a bit of a bad news is good news situation yesterday. Very important, guys, this week, Thursday, PCE this Thursday, the preferred inflation measurement tool for the Fed. And on Friday, unemployment and non-farm payrolls. So absolutely critical data points coming out Thursday and Friday as we are beginning this new uptrend. How the market reacts to these data points is still up in the air. Obviously, a lower than expected PCE will be bullish for the markets. Non-farm payrolls, anything that's below expectation will be bullish for the market. Unemployment rate, a tick higher, will be bullish for the market. ISM manufacturing PMI, the market will want to see this number stay roughly flat or in line with expectation for a bullish reaction. So the market wants to see inflation coming down, that's PCE coming down. It wants to see the jobs market cooling down because that helps core inflation come down. So they want to see unemployment tick higher, they want to see non-farm payrolls tick lower, and they want to see manufacturing stay roughly even. We don't want to see significant declines in manufacturing because that would indicate an imminent recession. Clearly, guys, based on the yield curve inversion, the economy is going to enter recession. The question is just when. And if the Fed begins to cut rates before we actually see recession, that will be bullish for the market. But eventually, everything will come down when the recession actually hits. Obviously, guys, this is one of the most anticipated recessions. That's why we're seeing all of this craziness and in the market behavior where the market is not really pricing in recession, because when there's high certainty around any event, the market tends to pretty much ignore that event. It's only when a very few number of people actually realize something and the vast majority of the market is ignoring it, that's when it actually becomes a problem. When the entire market is aware of it, that's usually when it's not a problem. So far, the market is completely ignoring all recession fears until and unless it actually becomes a real issue, and that will happen. That it will eventually happen. The question is only when. If you enjoyed the video, guys, slap that like button right in the face. That would be really appreciated. If you watched till the end and you did not enjoy the video, I thank you for your time and attention. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.